the reason why GameStop is going crazy, right? And you might have heard a lot of this week, these two terms, and I want to break them both down for you just so you know what they're talking about when you see it on, CNBC or Bloomberg or whatever you follow. And that is the short squeeze and the gamma squeeze. These are two things that you've probably been inundated with, whatever news feeds you watch, constant chatter about the short squeeze in GameStop. And then when people try to sound a little bit more clever, maybe they'll say the gamma squeeze in GameStop because, that sounds a lot cooler than short squeeze. So I'll explain what these two things are, and then we can go from there. So the short squeeze, that's an easier one to understand. When you're short a stock, you profit when the stock goes down, right? So you're shorting it. Let's say you short a stock that's at $10. You're hoping that stock goes down. And you're borrowing those shares from your broker in order to execute that trade. It's not like you own them already and you're doing some type of complex thing. You're just borrowing shares from your broker. So if you would imagine what starts to happen when the stock is climbing, for whatever reason, maybe there was a catalyst and it starts going up, now your short position is going against you and you're starting to lose some money. So what you would call the weak hands, the people that maybe were too leveraged, they don't have the capital in their account to sustain those losses, whether it's they're electing to close their position or whether their broker's actually forcing them to through a margin call, they have to cover that short. And in order to cover a short position, you go out and you buy the shares, right? You just purchase whatever you were short and borrowing, and that's how you close the position. But the act of buying those shares and closing your position may actually, cause the thing to go up further. So then the medium weak hands have to close their positions. They're in the same position as before because it's continually going against more and more people. And you get this little feedback loop where the more people that are being under pressure from their short position, the more people have to go out and buy the stock. And that purchasing of the stock can cause the stock to go up further, making more people have to call their broker and cover their shorts. And again, you can see how this could be a feedback loop if enough people are short and there's a catalyst to push that stock higher. It can just keep feeding on itself, and you can see stuff, a $10 stock, a $5 stock, go up extremely high. And that's partially what we were looking at. That's a short squeeze. They're fairly common. Well, I shouldn't say common. I mean, as a percentage-wise, I would say rare, but not unheard of, let's say. You hear about short squeezes quite often, and you can check the short interest on a stock and sort of target which ones are possibly more susceptible to a short squeeze. The one that's a little bit harder for people to understand is the gamma squeeze. And I suspect on GameStop, we're seeing a little bit of both. So I should explain the gamma squeeze as well. It's essentially, it causes the same outcome, but it's for an entirely different fundamental reason. So the gamma squeeze happens because the options market is going a little crazy. So when you buy an out-of-the-money option on a stock, right, let's say it's, again, trading at $10, and you buy a $15 option on that stock. You want the stock to go up so that your option gets in the money and you can make some profit there. So on the other side of your trade, some people have this idea that some random dude out there sold you this stock and you bought it, they sold it, and it's you versus them, and you're sort of pit against each other in this zero-sum game. It's not actually what's happening. What's happening is there is a middleman there. There is a market maker. There's dealers that are actually facilitating that trade. And so what they do, because they're not interested in actually profiting from the underlying movement of the stock, they're only interested in making a little bit of money on the facilitation of the transaction. They have to go out in the open market and hedge that position so that they're not overexposed, because they're on the other side of the trade, not some person out there. The market maker has to make sure that they're flat, what we would call delta neutral, right? So delta is the option that measures the sensitivity of an option based on underlying price movement in the stock. So they go out, and the most common way to hedge out their risk on their side, which they have to do, because again, they're not trying to profit from this, they're just trying to remain neutral, they have to go out and buy shares. Now, there are other ways to hedge, but buying straight up shares is probably the easiest, most one-to-one direct way. So they just go out and buy enough stock to cover that option that they sold you. So if the option goes up, they have the shares and everything's fine. But gamma, this is where the gamma squeeze comes in, Gamma is a second order derivative that measures the sensitivity of basically delta price movements, the acceleration of price movement with respect to movement in the underlying. And it can be an accelerating factor. So imagine your $15 out of the money call. You get the stock that was at 10, it starts climbing up, right? Let's say it goes to 15. Now that $15 call that was out of the money with a lower delta and a lower gamma, now all of a sudden it's at the money, and the gamma and the delta is increased, and the exposure from that market maker is now more. So what do? They have to go out and buy more shares. They have to dynamically hedge this position as the stock is rising. And what does that cause? Could potentially cause one of these feedback loops where the dealer has to go out and buy more shares, and then those options become more and more in the money. And then, of course, market makers are always opening new out-of-the-money strikes, and more people are buying those. And then those out of the money become in the money. It raises the gamma exposure of the market maker. They have to buy more shares. Stock goes up even further. And again, you can get one of these really odd, doesn't happen very often, feedback loops. One might be able to make a case that that's why we've seen the stock market rise so much. Things like Tesla, things like Apple, the broad stock market. You could make a case that this is sort of a gamma squeeze type environment, not at the same extent as GameStop, but a sort of a mini gamma squeeze, essentially, where there's a lot of options being bought and sold, which is why we see the VIX index, persistently high, but the market climbing to all-time highs. It could very well be this sort of dynamic of feedback loop at work. So that is essentially the difference between a short squeeze and a gamma squeeze. They have the potential to lead to the same outcome, but for a fundamentally different reason. So the short squeeze is just because, shorts have to continuously cover their position, and that can push the stock up. And gamma is those out of the money options getting progressively closer to the money and in the money, causing the market makers to have to continually buy more shares to hedge their position and hedge out that risk. So when you get two of them together, you get maybe a little bit of a short squeeze, a little bit of a gamma squeeze, put it all together, and basically what you get is something like this. So this is GameStop. Check if I'm on screen share. Good. This is the now infamous GameStop. Now it's still at 230. I'm surprised it's been so resilient, but you can see that before all of this happened, it wasn't that long ago that this was a $5 stock. Right? And it wasn't that long ago at all. It was just, a week and a half ago where it was a $20 stock. Now, what can end up happening, of course, is you need something to light this fire. So the way that I think about this is something like GameStop is what you want if you're a buyer of the options or a buyer of the stock and you're participating in these little forums. You want just to create this massive bonfire where the thing goes out of control and everybody who's long makes a whole bunch of money, right? You need a couple of key ingredients to make that bonfire. The first one, consider the wood, right, that you pile up. The wood that you're piling up is the short squeeze. You want something that has high short interest. Now, oftentimes high short interest just means high short interest. There's no resolution. It doesn't mean it's going to spike up. It just probably means for good reason there's high short interest. So that in itself is just a pile of wood. The gasoline might be your gamma squeeze, where you have an underlying stock with high short interest and you've got a lot of options being traded, especially out of the money options. Now you've taken your pile of wood, your short squeeze, and you've doused it in gasoline, which is your gamma squeeze. But still, you've just got a pile of wood doused in gasoline. You actually need something to, light that and get it going and create this massive bonfire. So that's where things like Wall Street Bets comes in, and all of these people making YouTube videos, pumping up these fairly low volume stocks. These, I don't know what GameStop was at before. It was probably I'm going to take a wild shot in the dark. You're probably going to fact check me next live stream, but probably a $2 billion company. I'm guessing. I have no idea. I'm just going by the stock price. Wouldn't even have been that big. I don't know, but I think it reached something insane, 30 billion valuation or something. You get a lot of people who are pumping these things up. They're making videos. They're talking in Reddit forums. They're actually able to light that fuse. And of course, that's what Wall Street is angry with, because that's Wall Street's trick. The whole pump and dump, that's what they've been doing for 30, 40 years. That's what all these hedge funds are doing. Where's the difference? They're essentially scouting out stocks that they have chosen, that they have positioned in, and now they're going out and telling everybody how awesome they are. They're going on CNBC, they're going on Bloomberg, they're going on all these things, telling everybody it's a great stock. You get Jim Cramer out there hitting the buzzers and the horns and doing his thing. Where's the difference? Why can people not have a forum like Wall Street Bets? Why can't they be the match that sparks that bonfire? And I think that that's what we're seeing today. We're seeing this real battle between the old bag of tricks that Wall Street has been doing for decades colliding with the social media world, this new phenomenon where, 10 years ago, this just isn't possible. The old trick 10 years ago was to find a stock that maybe looks a little bit shaky and you release some type of scathing, libelous report, basically telling them that there's accounting fraud and it's going to zero. And then you're already pre-positioned and you watch the thing collapse. That's not really possible to do 15 years ago because you just can't get the reach. But nowadays with social media, that Wall Street Bets forum that we were all sort of interested in recently, that I knew hardly anything about before a few weeks ago, you go on there and you realize, wow, there's 2.5 million followers. There's 800,000 people with capital ready to allocate in these forums. And even if they have a tiny amount of money, even if their trading accounts, just all of them together are only $5,000 accounts, you get 800,000 people doing the same trade with a small account. Well, there you go. It is enough to, light that bonfire, which is just a pile of wood doused in gasoline. Now social media can light those fires. And that's what Wall Street is not really appreciating now, is that they're seeing the result of that. And of course, we have heard stories, and it's hard to gauge how accurate the stories are, and we still have to wait for all the dust to settle here on how much losses they take. But we have heard that there are some hedge funds that are actually trying to fight against this by maintaining their shorts, doubling down on their shorts, trying to fight it. It didn't work. The thing skyrocketed even further. And now we are in a situation where you're starting to see, well, I'll just say it, outright corruption, attacking this stock, basically. What ends up happening is, down here, they don't like the fact that funds are losing money. So they've got a few tools at their disposal. They can raise the margin requirements, try to squeeze out a few of the people, make sure that not as many people can continue to do this trade. Well, that didn't work. The stock's still going up. So what else can you do? Well, you can limit the number of trades that people can take. You can say that there's no complex options allowed on this product. Okay, we'll stop people from doing that. Okay, that didn't really work. It's still going up. So what do? Well, you raise the margin requirements more. You start reducing people's ability to trade more because they're trying to save their financial industry friends here from taking insane losses. And of course, the elites in the financial industry, and whatever you want to label them, the man, whatever, they do have quite a few tools at their disposal. But this was one of those cases where at every step of the way, they tried to crush it and it just wasn't working. I mean, it was really resilient. When you see something like this in a stock that's already gone parabolic, this is typically the beginning of the end, right? You'll see it crash like that, just a cascade downward. And that's not a small move. That's from 318 down to 218, right? It'll recover a little bit. And then this move down, you could completely forgive people for, bailing out on this right there on that bar. That's pretty much what I was expecting to see, but it rallies. And so now they have to reduce trading further and they have to limit everybody's choices and raise the margin requirements, and unbelievable resilience to go up to 500. And then again, you see one of these cascade spills downward. That's got to be the end of it, right? That's it right there. No, it recovered. It went back up. Then it cascades way down, but still back up to 300, bouncing around at 220. This thing is unbelievably resilient. And I think, I'm no expert on these things. I'm not in the financial industry. I've never worked in the financial industry, but I suspect there's a lot of people they see the writing on the wall here, and they see that there's an animal been released here, and it's sort of all bundled in together with the social media animal that we are all trying to cope with and deal with. And it's affecting all of our trades, whether we want to acknowledge it or not. The collision of social media with the trading world, it can have serious ramifications now. I mean, in 2021, in 2016, we would say, that's adorable. Look at these retail people. They're trying to influence the market. 2018, there was a couple instances where they, some significant things happened, but still, it's just Robinhood. Just ignore those Robinhood traders. Well, now we're in 2021, and turns out if you get 1 million people together in a forum with a little bit of cash, each one of them, they can inflict a lot of pain on these larger funds. Now, you won't see this happen on Apple. It's a market cap that's way too large, but you can see it continue to happen on smaller issue stocks. So the last thing I want to end with here, because I do like to balance things out, I want to issue a little small warning to all of you, because what you're going to see in the next several months and maybe the next several years is you're going to see a lot of people on Twitter and on YouTube and, these forums who are going to be selling you courses and selling you subscription services, teaching you how to find the next GameStop. They're going to be in the business now talking about gamma squeezes and I've got the next one, it's this one. I want you to understand that these things are very rare. And like I said, just because there's high short interest, typically that just fizzles out and dies. The short interest is there for a reason. It's a garbage underlying stock and nothing is going to happen. The vast majority of the time, that's the case. Gamma squeeze the same. Just because there's high open interest on out of the money options, you can screen for all these things. Just because that's the case doesn't mean that you go out there and you start laying significant amounts of capital trying to find the next GameStop. All right, there's going to be tons of people convincing you that they can do that. And essentially, here's what their business will look like. You can go to a free stock screener, right? This is finviz.com. Anybody can go to this thing. Just click on screener, click on all here, and you can just start adjusting these things, right? These little categories. So the first thing you want is optionable and shortable. So first of all, I'll untick that. You can see we're starting with 7,632 stocks, right? Obviously, you can't trade 7,600 stocks, so you want to make sure that they're optionable and shortable. Now we're down to 4,388. The next thing you want to look for, and it's been ages since I've looked at this, so now you want to look for high short interest, right? Remember, that's the wood. We're trying to build this big bonfire, so I wish somebody could help me out here. My eyes are okay, this will do. What's the maximum we can do? Over 30%. Now we're down to 56 stocks. Okay, and what are some of these stocks? Well, they've been in the news recently. There's AMC. AMC's been going crazy. Let's go to the next page. There's our old friend GameStop right there. Just 2 screens. We've got 56 stocks. There's a lot of people out there that are going to be telling you that this is how you find the next GameStop, and now you just slap a bunch of money on all these little names here. You can even go a step further. Remember, you said it has to be a somewhat small company. So let's say from 300 million to 2 billion. How many have we got left? We've got 18. Okay, we've got 18 little stocks that are 18 little potential bonfires here. We've got high short interest. We've got optionable. I didn't even screen detailed wise to see how much out of the money, and you can do all that with Thinkorswim. There's going to be a lot of people telling you that this is the thing. Send me your money now. I can find you the next GameStop, and then we're just going to buy out of the money call options on all of these things, and we're going to make $1 million. So just be careful that this is the financial industry. And like I said, we are seeing trading colliding with social media. And there's going to be people out there trying to take advantage of others who, maybe you have a cursory understanding of what a gamma squeeze is. You saw it in the news somewhere, and you might be susceptible to paying somebody a bunch of money when really these things are completely unpredictable. I mean, I would never tell anybody what they should or shouldn't do with their money. So if you want to do this, go ahead. We narrowed it down to 18. Do your thing. For me, this is not something that I would invest any capital into. It's, trying to find the next one. You'll have so many losers for every winner. And again, it's not going to be GameStop, right? This was just a wild, bizarre thing. We're not going to see another GameStop a month from now. Now that I've said that, it's going to happen. But we're not going to see something that goes from $4 to $550 that is a garbage stock. They're probably going to put a lid on this somehow. They've already tried. They've already tried. So the lid will be put on this, and it will be very difficult to scour for the next one. But as you just saw, I could sell you a subscription right now, right? I just showed you how to screen. I've narrowed it down to 18. I know the next GameStop. If you send me $500, I'll tell you what option strikes to buy and sell, and I'll tell you how to make money off this, right? I have a following on social media. I could do that. So that's what I would caution people against. It's one thing to understand what happened, very important. It's quite another thing to actually successfully seek one out and succeed at it. Most likely, it'll just fizzle out. Short interest remains short interest. Out of the money options remain out of the money options, and they expire worthless. That's most of the time what's going to happen. Now, again, I'm not telling you can't, but I would say be careful. Keep your allocations very small. You want to buy some type of $2 option, okay, fine. But don't dedicate too much of your capital to this thing. The seeking out of the next GameStop. But I can see it now. There's going to be a lot of services popping up in the next couple of months trying to do this to people. So if you want to know how to do it, email me, teach you how to do it for free. I'm not going to sell it to you. I can show you. That was just a FinViz public screener. We got it down to 18. We can do way better than that. We can narrow it down. We can look at the level 2 options. We can do all these things. And I could make it look like I've found the next one when really I'm just rolling dice. So don't pay me money for that service. Don't pay anyone else for that service. It's not worth your money. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.